Hi, this is Daniel, and you're watching Unrivaled Investing. But beware, this is a no hype zone. We just focus on the fundamentals. We're looking at the unrivaled value propositions. We're looking at their market, trying to size up how fast can they grow in the years ahead. We are looking at what's actually going to drive this business. And today we are looking at Clover Health, which is merging with a SPAC, IPOC. So, what is IPOC? What is Clover Health? What's their business model? What do their financials look like? How do they make money? Do they have an unrivaled value proposition? Regular viewers know that's the lens I look at. All companies wipes out 95% of the investment universe. Because if you're unrivaled, it means you have a right to win. If you're rivaled, someone's going to take your lunch. That's how it works. And so, what's the opportunity? If you're unrivaled and you have this right to win, and you're targeting a big market, I want 10x potential. I want them to be tapping into a big market. Then I start getting pumped because you're looking at big opportunity plus the right to win because you're unrivaled. That spells attractive returns for shareholders. And then lastly, I have a free investment calculator for you, my loyal YouTube viewers. You make it to the end, you go to it, and you can play around with the scenarios yourself for what you think IPOC Clover Health can do in the years ahead. But before digging in, if you enjoy learning about potential multi-baggers, the types of companies that can go up hundreds or even thousands of percent over time, make sure you subscribe. And if you're already a subscriber, make sure you hit that like button. And you know what? If you want to know what I'm personally doing in any given month, what am I buying? What am I selling? What am I holding? You can't take these shares away from me. Go to unrivaledinvesting.com, click on Journey. And the truth is, the secret that most people don't know about investing is that the reality is it only takes potentially one multi-bagger to change your life journey. So if you're interested, go to unrivaledinvesting.com and you can follow my journey as I'm trying to find these multi-baggers. Also, I love it when loyal subscribers are like, hey, can you check out this company? As a matter of fact, a Journey subscriber earlier today, I think it was Raja, he's like, hey, can you help me out with IPOC? Here it is for you, looking at Clover Health. So IPOC, ticker IPOC. They're actually, the name is Social Capital Hedosophia Holdings Corp 3. This is actually one of several SPACs that the famous star super investor Chamath Palihapitiya has done. He's reserved IPOA through IPOZ. IPOA, a lot of people may or may not remember, was the Virgin Galactic. IPOB, Open Door. I already did a video about that. So if you're interested in learning about his SPAC history, click on IPOB or go to IPOB in YouTube, just because I have a lot more background on who Chamath is in that video, because he is an all-star. He's a clear thinker. I don't necessarily always agree with him or agree about the prices he's paying for things, but you know what? His wallet can crush mine, so he's worth listening to. But real quick, what is a SPAC and what is the terms of the transaction? So generally, a SPAC is a pile of cash just looking for a deal. Why? Because the SPAC founder tends to get a percentage of the company as a fee for doing a deal. In this case, Chamath is getting nearly 5% of the company. Holy smokes. Imagine if you could bring me you if I were to say, hey, I want to bring myself public as a stock, it's going to be the Daniel Unrivaled Investing stock. And the fee that Chamath would get for bringing me public is he gets to own 5% of me, or 1/20th of me for doing that. Like that strikes me as pretty rich. I've definitely seen other SPACs with much lower percentages. So I think there's a little bit of name brand here where he's like, booyah, I can get this deal done. I know rich people and I have a history of crushing it. So you should do it. So that's, I mean, if Clover's worth around $4 billion, he's getting a cool 200 million just for closing the deal. That's helpful for you to think about. Yeah, even if he puts in $100 million to do the deal, he's getting 200 million back. So it's the rich just get richer. That's how the game's played. What about the terms of the deal? So you could see 800 million from the SPAC, another 400 million from a PIPE or private investment. That's friends of Chamath. And most of it's going to balance sheet. Bothers me a little bit that 500 million is going to pay out existing shareholders. That's more than the entire pipe. Definitely don't see that with all the companies. I did a video actually earlier today, where all the proceeds is going to shore up the balance sheet, and no, there's no secondary shares sold. So that bothers me a little bit. So a lot of money is going to the existing shareholders, more than the entire pipe. You can see what the share structure is going to look like, where the existing IPOC shareholders get about 19% of the company. Pipe is another 9%. Existing Clover shareholders around 68%. And then the IPO sponsors, so that's him, is that 4.8% or 4.7%. So what is Clover Health? Because at the end of the day, that's going to be what drives your return over time, not some sort of speculation of like, oh, this is gonna be an amazing deal. Like let's just bid this up. Let's hype. Like I am focused on fundamentals. What's gonna drive this over the next 5 to 10 years? So what is Clover Health? And Clover Health is a tech first pioneer in the Medicare private insurance market, or Medicare Advantage. So first, Daniel, what's Medicare? And if you have Medicare, why do you need private insurance? So, the way to think about this is that Medicare is a government program so that if you're over 65, the government makes sure it's a social safety net. Make sure you can get basic health insurance needs taken care of. But, but here's the big loophole is that if you're getting your needs taken care of, but you happen to need some medicine that's expensive, or there's a treatment that's, it goes above and beyond what they cover, then it's going to go to you. So it's Medicare. Yeah, it does cover you up to an extent. It doesn't cover everything. And so there's still this potential of catastrophic financial risk where you're stuck in a hospital for a while and you get financially wiped out from medical bills. So that's where private insurance comes in. Is like, hey, can we have lower costs than traditional Medicare and potentially save the elderly from blowing up financially? So that's part of what Clover does. They are one of these Medicare private insurance competitors. So what does Clover actually do to understand their business model? So what do you say you do here? So you collect premiums, which is your revenue. So the premiums are from the elderly that are paying, their monthly amount. Saying like, hey, I want insurance. That's the premiums, that's revenue. And as an insurance company, which Clover is, they're going to pay out medical claims or medical expenses. So simple business model, right? Like charge more in premiums than you pay out in medical expenses, right? Super easy. So what makes Clover so special? And the reality is it's a lot more than that. At the heart of it, Clover, it's an AI, this Clover assistant. And you can see like it's taking all of this data from the consumer side and layering it in to a platform that easily connects with the physician. For example, the primary care charts, specialist charts, your medical history data, your pharmacy data, everything's all in one place. That way, the doctors can also see it. This doesn't strike me as like crazy. This should be sort of table stakes. Maybe they have just a better mousetrap so far because of this. What's really important is if this is true, you're going to have really important secondary effects. And we'll get into that in a second. But where it starts getting valuable is like, hey, the physician will get effectively warnings of evidence-based protocols, potential comorbidities, like, hey, if you have this condition, you might have this condition. The reason why this is important is that there oftentimes are separate companies. One is electronic health record companies, and then separately insurance companies. By building this together, the insurance company and the health records, and combining it to work with the physicians, you might just have a better mousetrap than what exists out there. And so if you effectively have an AI that's telling your physician what the best policies are you more likely to get better care? If you have something that inherently flows through the system better, will you get better care? Will the patients, will the members get better care? And can you get secondary effects that really juice this, like lower costs? So why is all this important? And this is the secondary effects, the value proposition. Clover Health is attempting to build an unrivaled value proposition. That's what I alluded to at the beginning. An unrivaled value proposition is a key filter. It means you are unrivaled. Anyone else offering, Medicare private insurance, they may not be able to compete with them if you're unrivaled. And so that's the question. Is this unrivaled? We'll get into it. And they're trying to say, look, we are unrivaled. We're going to lower medical expenses. We're going to pay doctors more. That's going to be a secondary effect because we have a system that's so much better. We can afford to pay doctors more. We're going to lower the insurance costs. So you know what? Grandma, you're going to be paying less. And I tried to find a picture of a ridiculously happy grandma emoji. I recommend you check it out on Google. I didn't find any. So here's some pictures of my mother. Mom, I love you. Okay, so what were we talking about? So value proposition. Yes, they're building a win-win-win because at the end of the day, if the doctors are making more money and the patients are healthier, then you're getting this beautiful setup. And any situation that is win-win-win, you're creating a sustainable relationship. Any relationship that has a win-lose to it, like I'd say our current medical relationship, where every year, insurance costs goes higher, then that's not sustainable. You need something that's going to lower costs over time and improve care. And that's what excites me about Clover. Interesting to see here their net promoter score, which means what how likely are you to refer this company and say good things and effectively become an ambassador for the brand? 64%. This is incredible if you compare it against legacy, health record companies, electronic health record companies, which have negative ratings. Like people would say, I would not recommend this. They have positive 64. This is like in the same league as Netflix and Amazon. People love these brands. So this is getting me excited. When you see super positive net promoter score, that means long term you can lower your sales and marketing spend versus your competitors because people trust your brand. Okay, let's go through each of these aspects of their value proposition and how they could potentially achieve them, like lower medical expenses, paying doctors more, and lower insurance costs. So lowering medical costs or lowering the cost of treating patients, like here's an interesting example. You have Mrs. James' annual physical. The primary care orders a PHT lab test, which is just part of the annual physical. It's recommended by the Clover assistant. That's a key point. And as a result, the Clover assistant receives results, notices that the PHT is a little bit elevated. And so they're like, you know what? We recommend you take these medications and you stay healthy. In the realistic scenario, the way the rest of the world works currently, or the way the rest of the US healthcare system works, is that you may have an overworked physician. He or she is not thinking about all the tests they need to order for Mrs. James. And so while they had the annual physical, and Mrs. James seemed healthy, they missed certain markers or they forgot to get this PHT lab test. And as a result, they missed the fact that that Mrs. James has kidney disease, chronic kidney disease, stage 4, and that later on suffers from a fall and a broken hip and fatigue and $208,000 in costs for the system, whereas $208,000 in savings because you were able to run the tests first. And this is the key here, is that you need an AI that's smart enough to tell the physicians like, hey, this is best practice. This is what you should do. And keep in mind, this is how we can potentially save a lot of money in the healthcare system, is that prevention is worth way more than in terms of cost savings than the cure. Because if you're able to catch things early, it's so much cheaper, more affordable than treating something later on down the road. And so you need to have an AI that's attuned to that, as well as physicians that are attuned to listen. So it can't be like a Clover assistant that's like too bothersome. It needs to be the right balance of like, this is what you need to do. These are recommendations for the patients you are seeing today. So this is super interesting. It's a really interesting hypothetical. Are they actually lowering costs? And here's a slide from the presentation where they're saying, look, the number of hospital admits per 1,000 relative to the benchmark dropped 22%. ER visits were down 23%. If this is real, that's a game changer. Because if you can roll that out nationwide and save, 23%, and keep in mind, ER visits are among the most expensive. It's not expected. You're going into mega bills when you're going to the ER, thousands, if not tens of thousands of dollars. And so if you're able to lower that, by nearly a quarter. That's a huge deal. So, but I wanted to understand, like, where are they? How do I double check this? And they say in their footnotes, based on internal company analysis. I would love to flesh that out, because just saying based on internal company analysis, it's kind of squishy. And honestly, this is the crux of the thesis when we look at Clover Health, because at the end of the day, if you're not able to actually have an AI physician relationship that results in lower medical costs, you're not going to be able to do all these cool secondary things that makes Clover Health an exceptional company. But at this point, let's just trust management. I would say trust but verify. Like, as a potential shareholder, I would want to watch in the future, like watch them execute. But let's trust them at this point. Lower insurance costs, lower medical costs. So here's where it's interesting, where they could potentially charge less for insurance, where they have plans with the access of a PPO at lower than HMO costs. So HMO costs generally are perceived to be lower because you have to take the doctors that they tell you. Whereas PPO, it's sort of pick your own. It's the buffet. I want this. I want that. I want this. And so they're saying you could have the buffet at a lower cost than the HMO, which is the lower cost solution. So they're saying, like, yes, that makes me think unrivaled value proposition. If they're saying you can have the benefits of PPO, pick your own physician. Now it's probably going to be sort of restricted to say, hey, you're going to have to pick whatever Clover recommends, but it's not going to be like, hey, this is the set who you have. And they're saying not only is it more affordable than traditional plans, but it's also lower out of pocket expenses as well, where your copay is going to be lower, your specialist costs are going to be lower, your drug costs are going to be lower, and it's lower not only against the competitors, but also against Medicare itself. So 17% against the competitor total savings, 40% against Medicare. So if I'm hearing that, not only so it starts off by lowering medical costs, you can lower the amount you charge, and you can also increase the benefits effectively for your members so that they don't have to pay as much out of pocket. So, for example, Clover, the average annual cost out of pocket, for their Medicare population is around a little under 2,000. Whereas for the competitors, it's over 2,000. It's 2,000 to nearly $2,300. So this is this beautiful ecosystem going in place. Lower costs, therefore you can lower the charge, how much the premiums that your members are going to have to pay. And then can you actually pay doctors more, so that way people start getting excited, maybe even become a referral source? And yeah, that's what they aim to do. They aim to pay doctors more. They aim to pay doctors 2 times the industry reimbursement rate, because keep in mind, it's the insurance companies. Yeah, doctors can bill whatever you want, but I did a video on multi-plan, for example. And this is a perfect example. Is you bill them, and then the insurance company using multi-plan is like, you're only going to get 60 cents on the dollar. Here they're saying, look, you're not going to go through that whole process where you're not going to get paid for a long time, because multi-plan is going to have to run it through their analytics. Here you're gonna get paid within 4 days, and you're going to get paid twice, 2x what you can normally expect. So all those cost savings that multi-plan's doing, yeah, you keep doing that. This is how the physicians are going to get paid and want to get paid over time. And so that's really interesting. Another key aspect is that they call out how traditionally physicians spend nearly 50% of their time doing desk work or updating the electronic health records. Whereas using the Clover system, it's less than 5 minutes average time spent interacting with the Clover assistant. So if you could pay physicians faster, pay them at twice the rate, and dramatically save their time, I mean, don't you think doctors would love it? Don't you think that doctors could become a terrific source of business where they become referrals? And that's exactly what they aim to do, which is incredible, where they're looking to become a direct contracting business with the physicians, effectively poaching doctors to become exclusive Clover referrals or physicians. Clover is just playing a different game. Humana, watch out. Humana is one of the main competitors in the Medicare Advantage space, ticker HUM. Like, seeing, and keep in mind, there's much of it. It's like David and Goliath, but it's Clover versus Humana. This is super interesting to see, because they're saying, look, we're currently at 57,000 members. Let's just ballpark 60,000. They're saying we can get to nearly 300,000 by the end of 2021, because they've already established this direct contracting relationship with the physicians. 200,000 direct contracting lives have already been under contract. So that's going to dramatically accelerate their growth over time. I'm not exactly sure how they're going to implement this because it's not the doctor that orders the insurance for the patient. The patient is it's the member that ends up picking what insurance provider they want. So I'm not exactly sure like how they're going to be able to scoop this up, how they're going to be able to get the doctors to become exclusive. Like I'd love to understand that. I'd love to see some execution on this. I'd love to understand like what the revenue profile is if it's dramatically different. Because when I look at their financials and the revenue that they're ballparking, they don't show a change that's like a 3x difference. So there is some weird stuff going on there. I can get to that a little bit later. But either way, they're tapping into a strategy where they're just looking to own these patients. I mean, maybe it just becomes a referral process where these physician offices like have pamphlets that like we recommend you do Clover going forward, and maybe that's just it. What about their organic business? Like, how's excluding this direct contract business? What does their organic growth look like? And what's interesting is in the counties that they operate in with at least 50,000 members, they're steadily gaining market share. They've gone from 15% to, nearly 20%, now over 25%. When I see that you're taking market share, that means you're taking someone else's lunch. If you have a that's market's only 100%, you have one pie and you're slowly eating more and more of that pie each year. Yeah, that means you're able to push everyone else away and you're like, I want more of this pie. I'm going to make it happen. Yum, 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 yum. More apple pie for me. So that's a signal of an unrivaled value proposition. So it's just another data point to add when you're thinking about the thesis. Like, everything's smelling, super interesting, seems super interesting. Okay, an insurance company can grow super quickly. It's any insurance company can grow super quickly. All you need to do is sell unprofitable business. Like, yeah, underwrite something that's going to be massively unprofitable and you'll be able to get plenty of insurance contracts. But what do their financials look like? Is it financially sustainable? And yeah, sure, they've had terrific member growth. All this growth is not surprising, right? Like 30% CAGR member growth from 30,000 to 56,000. Their premiums are growing from 354 million to nearly 700 million run rate in 2020. Their EBITDA margins have improved significantly, but their EBITDA margins are way better than they would have been because of COVID. Because people, and they call this out in their footnotes, effectively, the elderly weren't going in to see doctors as much because of COVID. They're scared to. Makes sense to me. So if you don't really have a clear picture and it's still going to be unprofitable for several years, which is what they're penciling out, like you need to size up the unit economics to figure out like, hey, can this business be profitable? And they call that out here as well. They're painting a good picture saying, hey, in the first year, the average new member acquisition costs us a couple of $100. But over that lifetime, this member's worth, let's say, $5,000 to us. And you can see cumulative lifetime value here. And what's interesting here is they're saying the lifetime value versus the cost of acquiring them is 4 times, which is a reasonably, it's a pretty attractive rate of return. And they're saying, look, it results in stable recurring revenue, nice profitability over time. But what bothers me about this is reading in their footnote, or what's weird about this is that they say the lifetime value to cost of acquisition calculation is based on the first quarter uh, cost ratio results, medical cost care ratio results. And that bothers me quite a bit because this doesn't make any sense. Like in the first quarter, COVID, started coming in March. And so your cost ratio would have benefited from that. And so, for example, in 2019, their medical care ratio, and keep in mind the medical care ratio, that's like the cost of sales for any non-insurance business. Like you'd have your cost of sales, and that's your medical cost or medical care ratio. And then you're going to have gross profit. So they think their medical care ratio is going to be 70 to 85% over time. And that implies your gross profit. So after you collect your premiums, you pay out these medical expenses. your gross margins are going to be 15 to 30%. That's sort of what they're penciling out. Um, but you can see like there's this huge jump from 89 to 82% from 2019 to the first quarter. Why aren't they showing this chart on a quarterly basis if you're trying to make the argument like, oh, yes, we're confident that first quarter unit economics are applicable? It bothers me that they don't show fourth quarter 2019, third quarter 2019. Um, this it makes me wonder if there's a little bit of misleading here about the lifetime value to customer acquisition costs. Also, for them to say in the presentation, yeah, we effectively think our gross margins are going to be somewhere between 15 and 30%. That's a huge range. That means they actually aren't sure. Like in my opinion, like that in my opinion, this means they're not 100% sure what the full model is going to play out to. How much cost savings are they really going to get? How much are they really going to lower prices by? How much benefit are they going to really get by paying these physicians to become direct contracting, where they become a referral source? So this is sort of tricky to think about. I don't like seeing that wide gross margin range. That's a huge range in my opinion. How about what are the long-term economics that they're spelling out? And you can see in this that they're saying lots of growth. And that's obvious based on everything I've showed you. Like that chart earlier where they're like, yeah, we think we could do this by then. That I don't have to address, does this have 10x potential? It strikes me as super obvious. Like you have the graying of the population, and they're saying within a few years, they're within a decade, they're going to be 10x their size. So they're the 10x question. I feel like you can satisfy. Um, the question is like, do they have the unit economics? And they're saying, look, long term, we think we have 6 to 7% EBITDA margins. Lots and lots of growth, 30% growth year over year, and you're going to see continued, 30% plus growth in the years ahead. And I'm looking at this, and I it's just interesting to me. Like maybe they have lots and lots of growth, and they have EBITDA margins that are very comparable to Humana, and they're able to do that because they have comparable margins because they lower their prices so much and they increase how much they pay their doctors. So I mean it's interesting. I'm clearly there's an incredible growth story here. I'm excited about their value proposition. And let's take a step back. I'm excited to see companies try to disrupt the healthcare space in general. I've done a series of videos on it. Like, for example, I did a video on Amwell and Multiplan, Amwell ticker AMWL. It's a recent IPO. And I believe they're enabling the existing ecosystem of players. Same thing with Multiplan, enabling the existing players. And when I look at something like this gets me excited because you are tapping into this big market and you're trying to lower costs and you are growing rather quickly and customers like you. So like it does smell right. Everything about this is, seeing them take market share is exciting. Like all this stuff, it's turning me on. It's turning me on, baby. But you also have to size up what's the risk reward. The stock, for example, fell 13% on the day of the announcement. Today's the day it was announced. So clearly it wasn't super well received. Maybe people thought IPOC would be clean energy, and there's been some energy, clean energy froth lately. So the question is like, hey, why was it not received? What's the thoughts about the risk reward? And that's where I'm going to pencil out for you here. And that's my value proposition for you, is that I provide a free investment calculator for you to think about what you think the long-term upside downside is. And I'm going to walk you through this, but you can download this free hypothetical, valuation range. If you click in the description of this YouTube video, I'll have a link for you to click on. And that's for you to play with. Like, of course, the stock price can go way higher or way lower, but I'm just trying to provide a logical framework for what I think it could potentially do. Like, look, I have to live with my logic, so I want to have something that's logical, that makes sense. And if something goes way below, let me check my logic. Does it make sense? Like, do my numbers still hold? I'm looking to make. Mr. Market is not there to tell me what things are actually doing. Mr. Market is to serve me and give me good deals. That's the analogy that Ben Graham taught years ago and that Buffett has repeated many times since. Okay, so let's looking at Clover Health IPOC. around $11 a share, down 30% today. Around $5 billion company. Once again, incredible that Chamath is getting nearly 5% of this company for doing this deal. So 460 million in revenue. They're growing 40 to 50% this year. Long term, just in the last page, they were talking about doing 6-7% EBITDA margin. So I'm like, okay, let's pencil out 5-7% operating margins, because I don't expect D&A or depreciation or amortization to be a huge percentage of your expenses. So your optimized margins, what you could theoretically do in the future, is somewhere between 5 and 7%. Slap on a 25% tax rate, and you're looking at like 130 to 200 times earnings. That's honestly, in my mind, like pretty rich for a company that's growing 40 to 50% this year. The question is, what do you think they'll grow at in the years ahead? And that's why I've also added this section for you to play around with, of like, what's the appropriate growth rate? I'm penciling out 30 to 50% annualized in the years ahead. Maybe this is too low. Like maybe with their doctor direct, contracting relationships, they could pump this up 40, maybe 50% supposed to be on the downside. I don't know. I like to be conservative, so I'm putting 30% here on an annualized basis in the years ahead. And what sort of multiple? I'm putting 25 to 35 times. Like this is an insurance company. Like, what are the odds that some of the big players start adapting, or they revolutionize their system, or another player comes in? But 25 to 35 times for a valuation for 5 years out, in my mind, does strike me as still pretty rich. Maybe I'm wrong, but in the end, it pencils out to a not so great risk reward, where it's like, yeah, maybe you get 100% upside in the next 5 years, and maybe you lose half your money in the next 5 years. It certainly will be a volatile ride, because there's a lot of margin assumption here. We're currently they're significantly unprofitable, or they will be, post COVID, based on their investments. So my takeaway here is that I like Clover a lot. I like what they're doing. I think they have an unrivaled value proposition. But I'm just not so sure about this valuation. Like, for me, I prefer situations where heads, I can win a lot, tails, I don't lose that much. So Clover Health IPOC is going to be on my watch list. I'm going to be keeping my eyes on it because it seems interesting. I like Chamath. I'd love to be able to partner with him in time. I'd love for Chamath to build his own like Berkshire Hathaway, hopefully without these ridiculous 5% owning the company fees, but to be able to just partner him with him that way. And this seems super interesting. I'm just not so sure about the valuation. But if you do want to see what I am buying in any given month, go to unrivaledinvesting.com. Click on Journey to see what I buy, what I sell, what I hold. Exclusive content just for Journey subscribers. And as I mentioned earlier, all it takes is one multi-bagger to potentially change your life journey. So if you'd like, you can follow my journey as I try to find these multi-baggers by going to Unrivaled Investing. If you enjoyed this video learning about IPOC and Clover Health, please make a point to subscribe. If you're already a subscriber, hit that like button. Thank you so much for watching.